us.
It's a pleasure, Colin.
Let's start first by looking at the overall economic outlook for 2015. What does it mean for consumers and what can they expect?
Well, it's looking pretty good at the moment. The factory figures you've just showed are still showing disappointment, but I think that might change a little bit. Oil prices are the big deal in the world at the moment. They've slumped dramatically due to an increase in production capacity, so the supply constraints of a few years ago have been alleviated. And we're a fuel-guzzling world. The economy globally runs heavily on energy and on oil. So this is good news from an economic growth point of view, and I think you may see world economic growth improving somewhat as a result, and our own economic growth improving as well. And then, of course, what it also does, along with the global food price decline, is it brings about lower consumer price inflation. I think that alleviates the pressure on the Reserve Bank to hike interest rates somewhat. So yeah, lower inflation, stronger economic growth this year. That's a fairly positive story, although it's certainly not boom times.
Is that not going to bring about complacency in terms of people saying now, according to this index, if the risk level has been contained, then people will be back-footed and start borrowing more, consuming more?
I think that is exactly the danger. Now, what we typically find with human beings is the lower interest rates go, in other words, the cheaper the cost of credit, the more they are inclined to borrow. That's often not the way to go about it, and I would suggest it's probably not the way to go about it at the moment. If we look at the debt to disposable income ratio at 78.3%, it's down from its 2008 high of 89%. That's good, because that was painful then. We were highly vulnerable then, we know it. But I still believe we've got a high debt to disposable income ratio, and more work needs to be done in lowering that so as to become far less vulnerable to interest rate shocks. So given that the work is not over yet, given that we're still highly indebted, more work to be done, I would suggest that it's better for the household sector to use a period of low interest rates to further lower its indebtedness ratio and get into an even stronger position.
Now, what does this debt service risk index look at for them to determine that at the moment it has been contained and brought to just manageable levels?
It looks at three things. Firstly, the level of the debt to disposable income ratio. Obviously, the higher that is, the more at risk the household sector is. It looks at the direction of that ratio. Is it coming down as it is at the moment, which is good? That lowers the risk rating of that subcomponent. If it's going up, that's danger. And then thirdly, it looks at real interest rate levels, so interest rates relative to inflation. And the lower the real interest rates, the higher the risk. The reason for that is, and it alludes to what I've just said, is that people tend to take worse decisions on average regarding borrowing when interest rates are relatively low than is the case when interest rates are relatively high. We tend to think more carefully, we tend to make better decisions when the cost of credit is significantly higher. So that would be seen as a lower risk situation, which is somewhat ironic, I guess. People might not always understand that. So that component of risk is also declining as interest rates move up off their lows of a year and a half ago.
Now, looking at regulation and forecasting the level of indebtedness as it is right now and going forward, are we going to see credit extension being increased at the moment, and how is regulation going to come into place so that they can rather stymie the effect of reckless lending? There's work being done on that now as to how to, and there's ongoing work being done between the banks and the credit regulator regarding reckless lending, and I have no doubt, the credit tax is relatively new, it's only a few years old, and as time goes by, I would expect some improvements in everybody to get onto the same page regarding that. At the moment, though, household credit growth is relatively low. The consumer-related, the non-mortgage-related credit lending, which was strong 2-3 years ago, has come down quite dramatically, got low credit growth, and I think that disposable income growth can outgrow credit growth as it is now for the next year or two, and we can have a further decline in the debt to disposable income ratio. That's what I'm expecting. The one wild card really at the moment is the residential property market. It's relatively solid. Mortgage growth isn't extreme, but does that really start to take off in a bigger way, and the mortgage lending growth starts to grow at a more rapid rate? That's one of the big questions at the moment. It's looking pretty contained, but but we need to keep an eye on that residential property market for any crazy behavior that happened a decade, such as what happened a decade ago, should interest rates remain at these low levels for the next year or two.
Okay, we'll see what happens in the meantime. Right, thank you very much. We're talking here to John Loos, who is a household and property strategist at FNB.